Hello ladies and gentlemen, welcome back. What I'm going to do today is I'm going to go through how transactions affect the accounting equation. I'm going to look at the accounting rules and you're going to be masters of applying the rules in order to determine how transactions affect the accounting equation. You're already familiar with what's in front of you. We've got the accounting equation: assets equals owner's equity plus liabilities. You know the definition of a non-current asset, a current asset, capital, drawings, income and expenses, non-current liabilities and current liabilities. That's what you're expected to know already. What is a long-term investment? These other non-current assets are self-explanatory, but a long-term investment would be, for example, if you took out a fixed deposit, you invested extra money that you have on hand into a high interest earning account, for example, a fixed deposit, and you earn interest on that fixed deposit. Current assets: if bank has a positive balance, it is a current asset. We're using another name for debtors. We're saying accounts receivable. So that is what we are going to call people to whom we sold to on credit, accounts receivable. You may have done at school, debtors control. Debtors control, accounts receivable. The same thing, a current asset. Input VAT, I'll just tell you, you only need to be able to classify it possibly, but we do that later. Input VAT is a current asset. Then we have capital, what the owner puts in, and drawings, what the owner takes for his or her personal use. We're looking at a sole trader, and we always look at all the transactions from the business's point of view. You're the bookkeeper. These are examples of income: sales, services rendered, rent income, interest income, bad debts recovered. I'm going to tell you quickly what that is. If a debtor cannot pay us and we receive a letter from their lawyer saying the debtor has gone insolvent, we write off that debtor as a bad debt. But if the debtor comes into money at a later stage, the debtor might decide to pay us because the debtor has a conscience. And when the debtor pays us, we credit the account bad debts recovered. It does not go onto the debtor's account as that was closed. So if we receive money from a debtor who has been written off in our books at a later stage, we debit bank and we credit bad debts recovered. Bad debts recovered is income to the business. Commission, we can make commission on sales. And then there's also just another one I have come across in your textbooks, and that is fees earned. It's not on here, but sometimes we make a delivery on behalf of a debtor. Someone bought something from us on credit, we deliver it, and we charge the debtor. That they seem to record in our textbook as fees earned. We will debit the debtor's account or accounts receivable and credit fees earned. My point is, fees earned is another way to earn an income. It's not on this list, but I have seen it in your textbooks. Right, long-term loan. You can have a loan just to invest in the business, to run the business, a long-term loan to raise capital. A mortgage loan would be a loan in order to buy a property. These are both long-term loans. They are non-current liabilities, long-term loan. Current liabilities, for creditors, we're using the terminology accounts payable. If we spend more than what we have in our bank account, we talk about a bank overdraft, and if we owe the bank money, it is a current liability. This income received in advance and accrued expenses we will deal with when we work with year-end, they're adjustment accounts. I had left off there the expenses, but here are examples of expenses: cost of sales, rent expense, interest expense, credit losses, that is bad debts, another word for credit losses, bad debts, salaries and wages, insurance, stationery. I've spoken quite a bit about stationery. If you see stationery written like that, it's an expense. If you see stationery used, it's an expense. If you see in a textbook or a test stationery unused, you can put it under current assets. Right? I'm just saying what I've seen in your textbooks. I don't like that definition, but I'm telling you what I've seen and how it's been treated in your textbooks. So stationery unused, you can classify it as a current asset. Right, office consumables, things that are used up in the office, expense. So you know all these accounts now. And you know that too. What affects owner's equity? Capital drawings, income and expenses. It makes the acronym DICE. Right, we're going to look at how transactions affect the accounting equation. Assets equals owner's equity plus liabilities. Whenever there's an increase in the value of an item, we will say plus. Whenever there's a decrease in the value of an account, item account, same thing. We will use a minus when there's a decrease in the value of an account. Oh, there's a typo. Right, should have two C's. These are the accounting rules. So if you've got an asset, and I will elaborate on this in a moment. If you have an asset, for example, trading inventory, bank, and the value of that asset increases, the account gets debited. If we sell stock and the value of the stock on hand decreases, the account will be credited. Income increases owner's equity. For example, sales. When sales increase, there's an increase in income, the account is credited. Increase in an expense, the account is debited. When the owner takes cash or stock for his or her personal use, there's an increase in drawings, debit. When the owner puts more into the business, capital gets credited. When we owe more, for example, if we've bought from a supplier on credit, our liabilities have increased and the account will be credited. Right, this is where I elaborate on the accounting rules. So we got T accounts in front of us. The left hand side is the debit side, the right hand side is the credit side of each account. Now I've actually put in account names here. Inventory, you all told me, is an asset. Sales is income. Advertising is an expense. Drawings will decrease owner's equity. An increase in drawings gets debited. Capital, an increase in capital gets credited, part of owner's equity. Accounts payable, liability. Increase in liability will get credited. Accounts payable, another word, I've said it quite a few times, another account name sometimes used, creditors control, accounts payable. This account here is a summary of all your individual creditors. Right, inventory, current asset, sales, income, advertising, expense. Drawings, decreases owner's equity. Capital, it affects owner's equity. Accounts payable is a liability. Sales, what does income do to owner's equity? It increases owner's equity. Advertising, an expense. What is an expense? An increase in expense decreases owner's equity. Right, trading inventory, if there's an increase in inventory, debit. Increase in sales, credit. Increase in expense, debit. Increase in drawings, debit. Increase in capital, credit. Increase in liabilities, credit. If we pay a supplier, what we owe will decrease. There we go. So if we pay our liability, the liability will decrease, the value of what we owe decreases, and that liability account will get debited. For example, accounts payable, when we pay a creditor. So this here is another explanation of the rules. And this catches people out. I'll point it out as we go along. If an expense increases, it decreases what the owner is worth. If drawings increases, it decreases what the owner is worth, owner's equity. Right, if you struggle to remember these rules in the beginning, after a while, it's like counting, 1, 2, 3, 4. You know, increase in assets, debit, increase in liabilities, credit. But if you're struggling, when there is an increase in the value of the account, we debit expenses, assets, and drawings, and we credit liabilities, income, and capital. It would be nice if you knew your rules so well that you didn't need to remember them with an acronym. The more you practice, the better you will get at knowing whether an account is debited or credited. So when there's an increase, we debit expenses, assets, drawings, credit liabilities, income, and capital. If it's the opposite, when there's a decrease, we don't debit, but we credit expenses, assets, and drawings. When there's a decrease, we do not credit, but we debit liabilities, income, and capital. Not going to spend much time there. You've seen that, but now we're going to look at transactions and how they affect the accounting equation. Expenses, dice. Right, transactions. What are transactions? A transaction is a financial event that has an effect on the accounting equation, right? It has an effect on the AOL. So something happens, it involves numbers, and it has an effect on the accounting equation. These are the transactions that we're going to cover in this video. It's just some basic transactions. You will have to do other exercises in order to practice, but these are the most, or let's say quite common transactions. So let's get going with them. We're going to look at capital contribution, purchase of stock, purchase of equipment on credit, credit sales, cash sales, pay for insurance, drawings from petty cash, paid a supplier, took out a bond, paid an installment on the loan, on the bond, paid bank charges. Right, those are the transactions we're going to cover in this video to start this type of work. Right, so the first one, the owner Lawazi made a capital contribution of 250,000 and a receipt was issued. I'm not too concerned about the document at this stage. We want to know which account is debited and which account is credited and the effect on the accounting equation. Here are some steps to deal with this transaction. Read the transaction, identify the accounts involved, classify the accounts: asset, income, expense, liability, capital, drawings. Classify the accounts and apply the rules. So the first thing we did was we read the transaction, we identify the accounts. What are you going to do with the 250,000 that you received? You're going to put it in the business bank account. The other account, whatever the owner puts in, is going to be recorded in the owner's account, capital. There are two owner's accounts, what the owner puts in and what the owner withdraws. But at the end of the day, later on in the year, everything, all the transactions will kind of end up in the capital account balance. But more about that later. So we read this transaction, two accounts involved. Owner put money into the business, our bank balance has increased, and the capital, the owner's interest in the business has increased by 250,000. So we classify these accounts. Bank is an asset, and the rule says increase in assets, debit. Increase in capital on the business's books, credit. So we're going to have a debit and a credit. Then you're going to be required to show the effect on the accounting equation, AOL. Okay, increase in assets, debit. Increase in capital, credit. Now I'm interested here in account debit, account credit, and the AOL. The account debit is bank. Why? Increase in assets, the rule says debit. The account credit is capital. Increase in capital, the account gets credited. What happens to the AOL? Our assets increased by 250,000 and owner's equity increased by 250,000, because what affects owner's equity? Capital does. Capital increases owner's equity. Liabilities, there were no liabilities involved here. So you would have to know the account debited and the account credited and the effect on the accounting equation. That's transaction number one. Number two, which took place on the 5th of January, read the transaction, identify the accounts, classify the accounts by definition, and apply the rules. Calibre Education made a cash, which means one account will be bank, cash purchase of stock 7,300 paid by EFT confirmation slip. What are we buying? Stock means trading inventory. One account is bank and the other account is trading inventory. Now, trading inventory, the value of the trading inventory that we own has increased, but at the same time our bank balance has decreased. You know, these are both assets. Trading inventory, increase in the value of asset, bank balance, decrease in the value of assets. So trading inventory was debited and bank was credited. And if we have a look, account debit, trading inventory. Account credit, bank. They're the reasons which I have just mentioned. Under assets, you got a plus and a minus. 0 under owner's equity, and we don't owe anything as a result of this transaction. No liabilities. Next, a computer was purchased on credit from the computer store. So we're getting the computer and we're going to pay at a later date. No cash has been exchanged, right? We haven't paid for this. We bought it on credit. Get computer now, pay later. So there's no bank involved at this particular point in time because the computer was purchased on credit. So we read the transaction, identify the accounts involved. I think I'm going to group computers underneath equipment. We're going to classify these accounts that are involved, and we're going to apply the rules. So equipment, yes, computer. If computers were bought on a regular basis, computers could actually have its own account, and you could call it computers. But for this example, I'm putting it under equipment. It doesn't matter. It's not that serious because a computer is an asset and equipment is an asset. Now we bought this on credit, so we're going to have accounts payable. Equipment, the value of our equipment has increased, but we owe more. We owe our creditors or our supplier, the computer store, that amount of 12,000 Rand, and it's included because accounts payable is a summary of all our individual creditors in the general ledger. The account's name is accounts payable. We've had a look at the rules. Increase in assets debit, increase in liabilities credit. So the account that was debited is equipment. The account that is credited is accounts payable. The value of the equipment, which is an asset, has increased by 12,000 plus 12,000. No drawings, no income, no capital, no expense. There's nothing under owner's equity. But as a result of this transaction, what we owe has increased by 12,000. There we go. Credit sales. Now sales is very important because there are 4 accounts involved. The first thing you need to do is you need to record part A, the sale. This is a credit sale. So we've sold to a customer on credit. That means they have bought from us and they're going to pay for the goods at a later stage, not now. Credit sales. And credit sales will be recorded in an account called accounts receivable, which is a summary of all the individual debtors of the business, and sales. This is part A. Record the sale. How much does the debtor owe us? 2,500. How much was the sale? 2,500. Categorize these 2 accounts. Accounts receivable, you know, is an asset. Sales is income. Debtors owe more, increase in assets, debit. Income has been earned, income has increased, credit. Now there's a part B. At the point of sale, we say the trading inventory that we are selling gets expensed to show the cost of the sale. Before we get there, we apply those rules. Increase, increase. Right. Cost of sales is an expense. This is part B of the sale. And what are we getting rid of? Trading inventory that cost us 1,250. And what did we sell it for? 2,500. The selling part was the 2,500. The cost of the sale was 1,250. Now, cost of sales is an expense. Trading inventory that we own has decreased because we are selling it. It has left the building. So there are quite a few accounts involved in a sale. Increase in expense debit, decrease in the value of our stock credit. And this is the effect on the accounting equation. Part A, accounts receivable was debited. Sales was credited. What happened to our assets? They increased by 2,500. And what happened to our owner's equity? Increased by 2,500. Part B. Debit cost of sales, increase in expense. Credit trading inventory, decrease in the value of the asset. So under assets you got minus 1250. Under owner's equity, because there was an expense, increase in expense results in a minus under owner's equity. So now what we can do is, I've mentioned this before, we can say the sales amount minus the cost of sales amount will give you the gross profit for this one transaction. Sales minus cost of sales will give you the gross profit before you take off other operating expenses, because then you end up with the net profit. So from this transaction and recording it here, we can calculate the gross profit. Now note, this was a credit sale, so accounts receivable was debited. And now I'm going to do a cash sale. Everything is the same. The accounts involved are the same, except it is not now accounts receivable. It will be bank. Part A, bank and sales. Bank is an asset. Increase in the value of the asset, debit. Sales is income. Increase in the value of income, credit. Cost of sales, increase in expense. What has happened to our trading inventory when we make a sale? It gets delivered or picked up by the customer. This is a cash sale. This here is part A, and that is part B of the sale. When you make a sale, these two accounts go together and those two accounts go together. Right, bank and sales go together. If it was a credit sale, it would be accounts receivable and sales. And then the second part of the sale, debit cost of sales, credit, trading inventory. And if we look at the effect on the accounting equation, the account that was debited for part A, bank, account credit sales, what happened to our assets? Increased by 2,300. And under owner's equity income, increased owner's equity by plus 2,300. Part B, debit cost of sales, credit trading inventory, because we need to record the fact that there was an expense, and the expense of the sale was the cost price of the trading inventory that we sold. So trading inventory gets credited, decrease in assets, cost of sales, which is an expense, decreases owner's equity. What is the gross profit from this one little transaction? 2,300 minus 1,300 is 1,000. That is a cash sale. Right, insurance. Paid 1,000 Rand to this insurance company. Cash. Right, when you see that word cash, the one account will obviously be bank, because where's the money coming from? Our bank account. So we're paying for insurance. Insurance is an expense. So we will have insurance and bank. Now you can have any expense. The principle is the same. Increase in expense, debit. You could have had salaries and wages. You could have had packer material or stationery. And you paid for cash, credit bank, and debit insurance. Let's see why. Right, there's an increase in expense, and our bank balance has decreased. So our debits equal our credits. The amount was 1,000. There we go. That's what I just mentioned. And if we look at which account was debited, increase in expense, debit, decrease in assets, credit, minus 1,000 under assets, minus 1,000 under owner's equity, 0 under liabilities. That is the result of an expense being paid. Right, Lawazi withdrew 500 Rand from petty cash to pay his son's computer lessons. If you ever don't know something in the video, what it is, you have knowledge at your fingertips. If you don't know what petty cash is, you go and Google it, or you type it into ChatGPT or Copilot, and you say, what is the definition of petty cash? You can get the stuff in your own language. Ask Copilot or ChatGPT. Knowledge, if you have access to the World Wide Web, is at your fingertips. So you have no excuses. If you don't understand something, search for it. Right, Lawazi withdrew 500 Rand in petty cash to pay for his son's computer lessons. Issued petty cash voucher, that's the document that records this transaction. If the owner takes anything for his or her personal use, we don't go and record what it was for. We record this under drawings. And where did the money come from? The petty cash that was on the premises. Debit drawings, increase in drawings, debit. The petty cash, which is an asset, the value of the asset decreased, credit. Count debit, drawings. Count credit, petty cash. Minus 500 under assets because the petty cash decreased by 500. What does drawings do to owner's equity? It's a negative, has a negative effect on owner's equity. Nothing under liabilities. Right, this is a long one, but it's important. Right, next transaction. Paid the computer store the amount outstanding for the computer. Now I'll refresh your memory. We bought a computer store. No, we bought a computer from the computer store for 12,000 Rand, and we called it equipment. We didn't pay when we bought it on credit, but now we are paying for it. So if we are paying for it, the one account will be bank, and the amount of money that we owe will decrease by the purchase price on the 7th, which was 12,000 Rand. Let me show you what that means. In accounts payable at the moment, it says that we owe 12,000 Rand because originally we credited accounts payable with 12,000 because we bought it on credit. So we're owing this computer store 12,000 Rand. We are paying now. So our bank balance has decreased. Bank must get credited. Our liability has decreased. And we pay that 12,000 Rand. And now the account will get debited. Let me draw something here quickly. Right, hopefully you can see that. This says accounts payable, right? General ledger account. At the moment, inside accounts payable was 12,000. We credited that account on the 7th. There's 12,000 on the credit side. But now we are paying them in full. So the liability has decreased. Now there's going to be 12,000. And what do we owe this one creditor now? Nothing. Because there's 12,000 on this side and 12,000 on that side. On the debit side and the credit side. So that was just using some T accounts or a T account to try and make that a little bit clearer as to what's happened. So back to this transaction, we are paying the computer store minus, and the liability has decreased. Credit and debit. So accounts, the account that is debited is accounts payable, decrease in liabilities. The account that is credited is bank, decrease in assets. Minus 12,000 under assets, the liability has decreased by 12,000. I will show you some more details of that later. We paid a creditor, and that's how we record it in this accounting equation table. Right, on the 19th, took out a mortgage bond, 500,000. Going to pay back interest 15% per annum. Right, the interest is not being paid yet. All we're doing is we're taking out a bond to buy a property. Where's the money going to be put into? Our bank account. And we're going to have a loan with the bank. That's the name of the bank. Okay, loan the bank. What has happened to our bank balance? It increased. What happened to this long-term loan? The liability increased. Credit, debit. So account debit, our bank balance got bigger. Increase in the value of the asset. What happened to our liability with regard to the loan? It increased. So the results on the accounting equation, assets plus 500,000, liabilities, we owe another 500,000, zero under owner's equity. Right, paid the first installment on the loan. So we took out a loan, and I'm just showing you when we make a payment. So this loan looks like this. Loan with the bank, okay? We took out a loan, we credited the account with 500,000 because it was an increase in liability. But now we're going to pay back 100,000. We're going to end up debiting this account with 100,000. And if we said 500,000 minus 100,000, the new balance of the loan will be 400,000. But how do we record this transaction? On the accounting equation table. Let's see. Loan the bank and bank. Because where's our money coming from? Our bank account. Who are we paying? Loan with the bank. The loan is getting smaller. Decrease in what we owe, debit. Our bank balance got smaller, credit, because we're paying back 100,000. Account debit, loan the bank. Why? Decrease in liability. Asset, our bank balance decreased because we're paying out 100,000. So minus 100,000, minus 100,000 under liabilities. The account that was credited was bank, decrease in the value of assets. Remember, the advantage of a video is you can play parts of it over and over again if you don't get it straight away. Oh, great. We're nearly there. So at the end of the month, we received the bank statement, which is a document that summarizes all the transactions with regard to our business, Calibre Education, on the document. And we get this document and says, we have been charged 200 Rand bank charges. Now, bank charges is an expense. The money comes straight off our bank balance. Our bank account has gone down. Bank charges is an expense. Our bank account has decreased. Increase in expense, decrease in assets. So we have increase in expense, like I said, and a decrease in assets. The effect on the accounting table: debit bank charges, credit bank, minus 200. What does an increase in expense do to owner's equity? It decreases by 200. There were no liabilities. Now these transactions that I've shown you, there were about 10 of them. We've done a couple of exercises in class, so all we're doing is we're building on what you know already. You can get many different types of transactions, but I'm covering the basic transactions. But like I said earlier in the video, you can pay for a lot of expenses. It doesn't have to be bank charges like on this one. It could have been advertising. But what are you going to debit if it was advertising? You had advertising under account debit. We paid for advertising. The account credit would be bank. So it could be any expense. Can be any income. Can be any liability. Right? The same principles apply. If you can classify accounts, you know your list of accounts, and you apply the rules, then you're going to get the right amounts under the accounting equation. Just this last slide, it's not too important, but I'm just playing around. If you had all these transactions together, assets equals owner's equity plus liability. It's the ones we have done. And if I wanted to calculate what the owner is worth, the owner put in 250,000. There was income that we received from a sale. There was a cost of a sale. We made a couple of payments. There could have been drawings. There were bank charges. Now, how do you calculate what the owner is worth? Capital plus income minus drawings minus expenses. DAS. What is the owner worth? 249,550 by looking at that column. Now, I haven't checked this, but I'm explaining the principle. If we went and add up the assets and the liabilities, and you said assets minus liabilities, you should also get 249,550. I'm not going to add that up. Assets, well, there I have already, 249,550. So assets minus liabilities is equal to owner's equity. Look under liabilities. We had a liability of 12,000 because we bought from the computer store, but we paid them in the same month. Plus 12,000 minus 12,000 equals 0. And guess what? Assets equals owner's equity. 249,550, 249,550. Right, I hope you enjoy this video. Remember, you can watch it over and over. And when I see you in class, we're going to practice transactions and how they affect the accounting equation. Well done if you've got to this part of the video. Excellent. Cheers. Bye.